Well, good afternoon, folks. My name is Anthony Mento. I'd like to welcome you to our webinar here on October 14th. We're going to talk about split dollar life insurance under the current and future tax law. Just some quick housekeeping. This webinar will be recorded, so we will disperse the link to the recording at the conclusion of today's show. If there are any questions along the way, please feel free to type them into the chat bar. Myself and my guest, who I'm about to introduce momentarily, will address each of these questions at the conclusion of the presentation. There have been a lot of developments that have surfaced in proposed tax law planning strategies. There's a lot of banter back and forth within our industry as to what to do or what not to do through the close of 2021. So, without further ado, I'd like to introduce my special guest, a gentleman named Chip Chatlin. Chip is an attorney working with Lincoln Financial. Chip not only spent time as a trial attorney with the IRS, but he also helped write the split dollar regulations several years ago. So, is there a better expert to join us today and teach us about the inner workings of split dollar? So Chip, thank you for joining our session. Chip, as we dive in, let's maybe just hit the pause button and just get some commentary from you on the current status of the two primary tax bills that are sitting with Congress currently, which are the infrastructure bill and the budget reconciliation bill, and how these two items may impact our business.
Certainly. The current status is sort of a stalemate in Washington. The original idea was that the infrastructure bill would have bipartisan support and be adopted. And then the progressives said, well, wait, we want the social engineering provisions of the budget reconciliation bill, and we're not going to pass the infrastructure bill in the House of Representatives unless it's accompanied by the budget reconciliation bill. They brought it up for a vote last week on the infrastructure bill, and the progressives kept their word. They voted against it, so the vote failed. And at the same time, you've got the what at this point is inside Democratic Party infighting. You've got Joe Manchin and Senator Seema from Arizona that are drawing limits as to what they will accept, what they won't accept in the budget reconciliation and the whole tax provisions. If I had to guess, and I'm taking a little bit from Andy Friedman, who's a frequent commentator with Washington Update. He's targeted Thanksgiving for when the legislation might get done. And if that's the case, I think you will see the two bills combined into one, because the idea was that they pass one and then they pass the other. Things are not being helped other than Joe Manchin day before on Tuesday announced that he was moving off of his 1.5 trillion limit for the budget reconciliation bill and would be willing to go between 1.9 and 2.2 trillion. And that immediately prompted Nancy Pelosi to say, well, that's okay. Then we'll just introduce another bill after those two get passed to accomplish the rest of what we want. And so, that doesn't help the bipartisan nature of anything right now. But I think right now we're at sort of a waiting period while they work out what provisions they're going to keep and what ones they're going to lose.
Chip, we had a chance to catch up over the last week or so, and what do you think? What do you see to be the most obvious and pertaining to our business? I was surprised to see the exemption was tied to the infrastructure bill, where I think a lot of folks kind of looking at this reconciliation bill as the quote unquote tax bill. Give us some commentary around where you think the exemption may end up when this is all said and done.
Well, the infrastructure bill picked up a lot of the changes that President Biden included in his Green Book in June. And chief among those was rolling back the 2017 doubling of the lifetime exemption. And so there's been a little confusion that some of the media reports that the infrastructure bill is going to reduce it to 5 million. Really what they're doing is repealing the doubling that took place in 2017, and the inflationary impact. Technically, that would continue, but it started at 5. And so right now, if RIA is correct in estimating what the lifetime exemption would be next year of 12,060,000, then the lifetime exemption would drop to 6,030,000, even though the language says 5 million, that they're referencing back to that 5 million. So I think that has a fairly good chance of passing, if for no other reason than it's going to sunset at the end of 2025 anyhow. And so if you're a Republican, why have a huge fight over something that you're going to have to be in control to keep anyhow? And as we have seen from sort of the hostilities going on in Washington, if the Republicans take back control of the House, Senate, and White House in 2 years, then they can pass it again. So, I mean, but I think the change in the lifetime exemption is likely to stick. Now, unrelated to that, the annual gift exclusion will increase to 16,000. That's not being affected by legislation. That's just the natural inflationary adjustments to the annual exclusion. But it does present questions as to what somebody should do if they have a net worth of 30 to 50 million, then they probably ought to consider using all of their lifetime exemption this year.
Yeah, it's this torturous game of chicken here, where all signs point to the bill passing as of date of enactment. So there are two schools of thought here. One is hurry up, get your plans established, get everything funded, and the other school of thought is, well, we don't really know what the future holds, so let's kind of sit and think things through. I think one of the main takeaways we'd like to deliver to you, to the audience today, is that you can set things up with an element of flexibility and control, and lending yourself wealth with the option to potentially turn that into a gift is certainly an option that gives you control and flexibility, and utilizing that in conjunction with some other techniques such as slats and grantor trusts and private split dollar, split the elements of split dollar, we think could go a long way. So we're excited about this presentation and having Chip join us. Just some quick highlights here, Chip. I think all signs, and would you agree, all signs are pointing to the corporate rate going up. We don't know exactly what that number is going to be at, but somewhere around 24, 25, 26. The capital gains keeps getting thrown around. One thing that will dramatically affect our business, and that Fonseca is a huge advocate of on the Hill, particularly over the last several weeks, is Grantor Trust. Would you provide some commentary? And we'll dig into the mechanics of Grantor Trust. But while we're on this point, you provide some commentary on the potential Grantor Trust powers and the impact of how the reconciliation bill would affect that?
Yeah, as it stands right now, the Grantor Trust effective date of those changes would be date of enactment. And so it puts sort of an uncertainty if you look objectively at the lack of progress they've been showing in Washington, I'd say you have at least a couple weeks, if not a month or two, to set up a grantor trust and make contributions to it.
Yeah.
And one of the ways that you can do that is to set it up, fund it with a loan, and then if it looks like we're getting close to enactment, and again, the odds of the House and the Senate and Biden all signing it on one day are slim to none. But if you fund it with a loan, all you have to do is find yourself a notary and forgive 11.7 million, or for a married couple, 23.4 million of the loan. And you've made your gift prior to the effective date of the legislation, which in all likelihood, if we're talking about Thanksgiving, is probably going to get rolled back to January 1st anyhow.
Yeah. Yeah. And the impact of funding a trust, particularly an ILET with grantor powers, is there any risk of the life insurance being includable in the taxable estate? I know for all intent purposes, the majority of the 100 or so participants on today's call are life insurance professionals. So
right.
This is a big deal for our specific industry.
Well, the transition language that's in the bill right now is that if you make a contribution to, you could call it an irrevocable grantor trust or an intentionally defective grantor trust. They're sort of interchangeable. I have my own personal reasons why I sort of prefer irrevocable grantor trust, but we won't go into that. The structure of it is that if you make a gift after the effective date, the legislation says some portion of the trust will cease to be a grantor trust and will be included in the grantor's estate. So in the worst case situation, somebody has an existing grantor trust, they're not paying any attention and they dump a ton of money into it as a gift next year or 3 years from now or whatever. And suddenly it's become a non-grantor trust and it will be included in their taxable estate, some percentage of it. It's hard to sort of decide how they might deal with that percentage or portion. If they focus just purely on what's been gifted, then, I use the example, if I'm doing $100,000 contribution a year to the trust, and I've made 9 of those, and the legislation's effective, and then I make the 10th one that's required to fully guarantee the contract, then arguably one approach would be, well, that should be 1/10 would be included in the grantor's estate. But if the assets in the trust have appreciated a great deal from day 1 to year 9, when they make another gift, maybe that's not the right portion. And the bad part about it is we won't know until the IRS releases regulations. And that's likely to be a couple years after enactment. So everybody is going to be looking at that, and you're going to have experts that are saying, don't do anything with that grantor trust that could be labeled a gift, and that would be a contribution. So, make a contribution to that's presumably a gift. If you make a loan, well, we've got a lot of precedent. That's not a gift.
Right.
So I think people are going to be forced to switch to loaning some money to the trust. But obviously, one thing they could do now is pre-fund future premiums in an existing grantor trust before the effective date. We've got some clients that can afford to do it. We have others who could afford it but are unwilling. And then we have some that might be flexible. And those are the ones you want to lean on to go ahead and push the envelope and pre-fund the future premiums.
Thank you, Chip. And just lastly, while we're on the update here, another item that could impact our business significantly. Where do you see the future in step up and basis rules?
It was part of Biden's proposal.
Mm-hmm.
The progressives have liked it. Their argument is, and you just look at some of the leading billionaires right now, they probably have a cost basis in their business that's pennies on their billions. And so for those people, Congress is looking at, or the progressives are looking at that and saying, we need a bigger piece of the action from somebody who has highly appreciated assets than somebody who has had all their life savings in a bank account. And so there's no step up in basis there. And that will be an ongoing discussion in the future. Of course, the Bernie Sanders and AOC and some of the other progressives have been wanting to have a wealth tax laid across everything anyhow.
Yeah.
But right now, the step up in basis, I think, is fairly safe. They'd have to have a fairly high exemption because the vast majority of people, I took over my father's finances after he had a series of mini strokes. And he had these little index cards with every stock he had bought and what he paid for it. And that was all real nice, except it didn't match his brokerage statement in any way, shape, or form. And so you're sort of sitting there and you research splits and things like that and stock dividends, and there was nothing. So while he was still alive, I didn't sell anything that I didn't know what the cost basis was. And so that's going to be the big problem with that. And they'll put in a couple $1 million exemption. They have to, because otherwise it's going to be too confusing for so many people. And the IRS has already opined, well, if you can't prove the basis, it's zero.
Yeah.
Which is not exactly what you want to hear from the dark side of the force. So yes.
Which we've experienced in, was that 2010?
Yes.
Yeah. So thank you. So I did have a couple of questions come up through the chat,
Okay.
Which I think I may just defer. One pertaining to Grantor Trust. I may just defer until this section on Grantor Trust. So
sure.
It's okay with you. We'll dive in here. I always have some fun with this picture. You know, right?
I love it.
AOC dress where we want to tax the rich, right? With the administration seems to hate successful people. So let's just talk briefly about, and this will all tie up for you really well as we progress through the slides. But let's talk about the strategies that we promote, meaning the folks on this call. We certainly use life insurance as an asset class, probably the most common approach or technique in our practice, whereby you're more focused on the wealth transfer at death rather than during life. But what's also been relatively popular, particularly through some changes under the Section 7702, is life insurance as a source of tax-free supplemental retirement income. And we can combine these strategies, particularly with slats and split dollar. We can manage our gifting exposure to split dollar. And then, of course, we'll look at commercial and private premium financing, where your private financing similar to split dollar. And just a quick refresher, if we're focusing on life insurance as an asset class, this is an opportunity to add a non-correlating asset to the portfolio of your clients, right? So if you're looking at a sample contract for a 60-year-old male, second best preferred, if these 10 premiums are paid, a $1 million death benefit is guaranteed. At 0% return, the cash value dissipates by, call it, age 75. However, if the sub accounts do well, you'll have a boatload of cash value. And at age 86, you're looking at, call it, a 5% yield on return, pre-tax equivalent of 7.3. That's a heck of an asset to own in your portfolio to hedge against stock market risk, interest rate risk. It doesn't really matter what the price of oil is or if there is a pandemic. These returns are guaranteed. So Chip, it's a big part of your practice. Any commentary around life insurance as an asset class?
Well, one of my colleagues actually spent years trying to be like a stock analyst and comparing rates of return to different asset classes and things like that. Again, with the objective of saying, okay, this asset class, equities, for example, may have a high historical rate of return, but at the same time, it's volatile, and that volatility can come back and bite you at the wrong time if you are trying to make sure that you have enough cash value in a contract to guarantee or keep a current assumption death benefit. So, it's something that when you start laying it against assets, you go, well, it's not subject to the stock market. It's not subject to the bond market. It's not subject to the real estate market. It's a non-correlated asset. And so that's the essence of the asset class, is that when you're using a guaranteed death benefit, it really doesn't matter what other asset classes, how they perform.
Well said. And if you shift gears just a bit, life insurance can also be used as a source of tax-free retirement income, right? So the asset class was more focused on the wealth transfer at death. The tax-free retirement income shifts the structure of the contract a bit to maximum fund it under Section 7702 and accumulate a whole bunch of cash values and possibly take tax-free withdrawal to basis. And where we're setting this up to go is the potential use of a SLAT under a split dollar arrangement using private loans. So not to forget the impact of a tax-free retirement income, particularly using life insurance that's funded just below the 7-pay limit. So as a quick example, 50-year-old sample IUL contract, and this is completely product agnostic. You can use a VUL or a whole life, whatever your flavor is. You put in $750,000 of premium, you can take supplemental retirement payouts of 1.75. So, if you look at cash flow IRR of 4.49 on a weighted assumed rate of 5%, that's a great play with an IRR equivalent of 6.24. So we'll come back and revisit these cash intense type policies when we get into the nuts and bolts of split dollars. So
yeah, now go back to that. There's one thing I want everybody to remember is that center column is the amount of cash they've pulled out. Right. The right column is the death benefit. And around life expectancy, which is distributions were 66 to 90. So you've taken distributions of a little over 1.6 million, but you still would have a death benefit of 453,000.
Right.
So you sort of have to look at that in addition to just the cash on cash supplemental retirement income.
And the opportunity to decide whether you prefer systematic distributions or you prefer to let the death benefit accrue. Right. So we spend a quick minute on grantor trust. Chip, in layman's term, what are grantor trusts?
Grantor trusts are any type of trust that under the IRS rules is considered to be owned by the grantor. And in that category, you have everything from the revocable living trust, which all of the income and all of the assets are included in the grantor's estate. But from an estate planning perspective, where the sizzle really starts to come in is when we're talking about an irrevocable grantor trust or a so-called intentionally defective grantor trust. And there are a couple powers that make it a grantor trust. One of them is the swap power or the substitution power, where the grantor has the right to trade assets into the trust in exchange for other trust assets. This has been very aggressively used in some very, very high profile mega multi-billion dollar estates where they have a terminally ill grantor, and the family business or real estate or whatever, it with a cost basis of 10 cents on the dollar is in the trust. The grantors, and sometimes it's been done under powers of attorney, that they go to the bank and they borrow $100 million and they swap the 100 million of cash into the trust and take out the untaxed appreciated assets. And then when they die, those assets get a step up in basis, and then you reverse the process. The 100 million goes back into the individual's estate in exchange for the assets that have now a step up in basis, and everybody's happy. They've beaten the tax man. It only works if you know when you're going to die to make that type of swap. But that's one of the powers that will create a grantor trust. Another power is the right of the grantor to make unsecured loans from the trust. And we use that frequently where we're trying to do sort of a supplemental retirement type play, because often very wealthy people, they're down to their 3 or 4 houses that they want to keep. They're down to the family business or whatever. And so they may not be as liquid as they would like. And so if they can borrow from the trust, then they can pay their living expenses. And when they die, there's a note payable back to the trust. And that, of course, reduces their taxable estate. So there's a lot of planning going around that. And that's what has attracted the attention of Treasury, IRS, and the progressives, is that those are deemed sort of abusive type transactions because they aren't paying the capital gains tax on the inside buildup of their assets, and they aren't paying estate taxes as much as they want them to either. So there's a lot of factors there.
Yeah, Chip, do you see a problem in toggling the grantor powers on and off, particularly if the new legislation changes? I know a lot of documents that we've read over the last couple of weeks maintain a trust protector who has the opportunity to toggle those grantor powers, and that seems to be an interesting, very flexible planning tool.
Yeah, I mean, certainly the trust protector would come in and remove those specific powers that turn it into a grantor trust. That could be done, or the grantor could renounce those powers. Obviously, if you have a non-grantor trust and you try to toggle it back on, then the result may be that all the assets in that trust will be included in their taxable estate.
Yeah, really messy.
So the toggling off will work if this legislation passes, but the back on again may not be desirable.
Could be problematic. Thank you. And I'll be sure to share the diagram here that just describes Chip's explanation. Just for briefly, How about the use of a spousal lifetime access trust? I mean, this strategy's been around for several years, but it seems particularly important now as the new proposed tax law is looming. Would you give us an idea on how you've been looking at using one of those supplemental retirement income designs that we just talked about, along with SLAT provisions?
Right. Well, for quite a few years, I had no problem with using a SLAT design with people that didn't have a high enough net worth to worry about the estate tax. Whether it was 3.5 million for each spouse, and that got it up to 7. For that type of person, the SLAT was often, particularly in this era of second marriages and blended families, it was a way to make sure that the assets got to where you wanted them to go. And so, and it also provided a source of cash flow or assets to the spouse. The higher the net worth, that becomes problematic because they had to use their lifetime exemption to fund the SLAT in the first place. And then they're pulling assets out and bring them back into their taxable estate. So they've sort of squandered their lifetime exemption. But we're in a different environment right now, in particular for the rich people that I feel sorry for, that are only in the $10 to $20 million net worth category. They can't give everything into a SLAT and without the intent to pull things out of it. And at the same time, if they don't use all of their lifetime exemption this year and it's cut in half, then they may end up with nothing. I use the example, somebody that has the 11.7 million lifetime exemption. This year they give away 6 million. And then next year it drops to 6,030,000. Under the structure, they're going to end up with a $30,000 lifetime exemption next year going forward. Now it grows, but you either have to use your full 11.7 or be prepared to have nothing left going forward. And that's the dilemma that some of them have. Now, I will look at a SLAT and I will say, okay, we'll set these up, but rather than a cash distribution to the spouse, the trustee could loan them money. And again, when they die, they'll have this note payable back to the trust, which is for the kids. And so whatever their taxable estate is, there's a deduction for the note outstanding. So taking the SLAT thing and adding a potential loan rather than a distribution, I think solves a lot of the potential issues.
Great foundation work here. So we have a kind of set the table. We have an expiring exemption, let's call it, or a significantly reduced exemption on the very near horizon. If for whatever reason it doesn't get through in 2022, it's going to get through at the end of 2025. So I think we can all agree that exemption is being rolled back. You couple that
Donald Trump would disagree with that.
True. This is true. So you couple that with the ability to utilize grantor trusts with spousal lifetime access provisions, and couple that with cash value rich life insurance, depending on your preference, or a guaranteed element death benefit focus. But so we've now kind of set the table for some very basic planning tools that can be implemented prior to the end of 2021. Now, Chip, how do we get the money in and preserve our gifting as very best we can and still create this element of flexibility and control?
And that's right up on your screen, split dollar.
So when do clients in your practice, Chip, and you see the largest cases of that are written come through Lincoln, a lot of the times hit your desk. Where do you see clients considering split dollar?
Well, historically, it's been the small business owner that doesn't have a pension plan. And so they are using split dollar funded with assets from the business. And then they are loaning it to an irrevocable trust. And most of the designs our life comp area has done over the years are supplemental retirement. We've got a number of them that from day one, it was estate tax liquidity. They knew they had an estate tax problem. They just wanted to use corporate dollars to pay the premiums rather than come out of pocket. And, loan regime split dollar was very effective for them. And it also minimized, back when we had a very small lifetime exemption. Wasn't that many years ago that it was, I think, $900,000. Mm-hmm. And so in that situation, your insurance premiums, the amount of gifting it would take would exceed the available exemption. So they were looking at split dollar as a way to avoid having to pay gift tax. And now just add another zero to their net worth, and we still have people doing that.
Yeah, I think asset appreciation has caught up to exemption limitations, and a sharp decrease in exemption could be impactful to planning. So, the use of split dollar, in my opinion, comes back to the forefront of planning strategies in conjunction with some of the uses that we've discussed earlier today in grantor trusts and SLAT provisions and cash value rich policies. So, just give us a little walkthrough on how you establish a split dollar plan.
Basically, the donor will create the ILET or the intentionally defective grantor trust or the irrevocable trust, and they will make typically a seed gift, but primarily they're going to be loaning assets to the trust, and they're going to be loaning the premiums. And the ILET, there's a limited collateral assignment back to the donor. So the portion of the death benefit that's equal to the loan balance would go back to the grantor's estate unless they either gift away the loan balance, or the policy produces cash flow enough to pay off the loan. And so that's the basic, all of that flows out of this flow chart that you've got up there right now.
Jeff, it seems so the ILET for all of us on the call is pretty easy. We just, refer our clients to their local estate planning attorney. Paperwork sounds complicated. You happen to know anyone or any department at Lincoln that could help us with these documents?
Yeah, I've been involved with our life comp area since Jefferson Pilot bought it from one of our top producers in Harlingen, Texas, and we moved a couple people and back to Greensboro, and I'm still their legal counsel because nobody in legal department where I used to be wants to deal with them. So it just, it's like, ask Chip. He wrote all this stuff, you can do that. But
all kidding aside, I not to turn this into a Lifecom commercial, but for $100 per participant, Lincoln will not only provide you with the proper documentation, they'll make sure the documentation is in good order and administer this plan and send annual administration kits to not just the client, but the client CPA and their legal advisor. So it's really, really a terrific service.
Right. And it makes sure that everybody is dotting their I's and crossing their T's on the split dollar. For years, I have reviewed some split dollar agreements that, the client's attorney thinks, oh, I can write a split dollar agreement, no problem. I'll do that, and I'll send it to Lincoln, it's life comp area, and they'll take care of it. And when I start looking at them and going, well, this violates the split dollar regulations. So it could be fixed, but this is the language we use. And generally the attorney throws his hands up and says, okay, all right, we'll use your form. Now, we do have some limitations. We use the blended AFR with life comp. And with the low interest rate environment, you have some people that say, well, we want to lock in the long-term AFR on the loan balance, and we can't administer that. And so they typically write their own agreement. They plagiarize our agreement and then lock in the interest rate as best they can. But it is something that we've had as sort of a turnkey type arrangement. We've got several dedicated people that will run illustrations for everybody. And then when we turn it over into the administrative system, everybody knows every year what gifts have been made to the trust, what loans have been made to the trust. And so we're producing all of that information that their attorney or CPA will need if they need to file a gift tax return.
Chip, when you're using split dollar, do you mind covering just the differences between the economic benefit regime and the loan regime?
Yeah, economic benefit's been around. It actually predated, for the most part, the loan regimes. It was equity split dollar. And Service got irritated with that. And when they released the split dollar regulations, they put that out of business. But they did preserve pure endorsement split dollar, which they labeled economic benefit. In economic benefit, the cash value is owned by the grantor. And out of the death benefit, the grantor, whether it's an employer or trust grantor, they get the greater of cash value or premiums paid out of the policy. And so what you have that the individual is receiving is just pure death benefit term rates for 1 year term coverage for whatever the net amount at risk is in the contract. And when you then switch over to survivor contracts, the term rates are absurdly low. And you have to step back from it and say, as a practical matter, no insurance company is going to issue a survivor contract with rates that come close to what the IRS is using, because the basic premise is it's two unrelated individuals who are standard risk on day one of the year, both of them dying that year. And with spouses, they're in cars together, they may be in planes together. There's a risk that they may both die in the same year, but the table is constructed that it's so cheap that it's very intoxicating. But the problem is, if you wait until one spouse dies, then you're stuck with the single life rates. And when you're in your late 70s, 80s, and 90s, those rates are very, very high. And you would have wished you had switched or started out with loan regime. And so
well said.
It's very well, it's very good. It's just that's economic benefit will work better with a option 2 or option 3 contract, increasing my cash value or premiums. The problem with the level death benefit is if you look at a lot of illustrations, the cash value is growing. And so by the time they get into their mid 80s, there's very small amount at risk. And so all of that, you failed to get all of that out of their taxable estate. So I tend to prefer the option 2 contracts. We're trying to introduce and hopefully next year we'll have a survivor option 3 IUL contract. It's been interesting discussions and arguments with the product actuaries, but there are some hurdles we need to get over, one of which is compensation. And so right now, option 2 is probably the best choice most people have.
Well said. And if you shift gears into the loan regime, when will you use loan regime, the Cliff Note version of when you would use loan regime over the economic benefit?
Well, certainly when I'm dealing with an older insured.
Right. Because
the economic benefit rates start to really take off in the 60s and 70s and 80s. Years ago, I thought interest rates were going to be going up at some time and that they'd be considerably higher than they are right now. But we've had this long sustained period of low interest rates. And so the loan regime is less predictable because the typical arrangement, the interest rate floats every year. And yet, loan regime works well with option 1, 2, and 3 contracts because the trust owns the contract and has been borrowing the premiums. And so all you're ever dealing with is the loan balance that has to be paid either during lifetime or at death out of the death benefits. I've seen, we're not selling much in the GUL space right now, but you used to see a lot of loan regime with the GUL just simply because the premiums were much cheaper at the time. And so all you were doing is paying loan interest on those premiums. And that worked very well.
Give us some of your secret sauce here, Chad. What do you like to do with loan regime, split dollar arrangement?
Okay, and this is also works best with a grantor trust. Mm-hmm. So just put that out on the table. What I like to do is the grantor loans the premiums to the trust for, let's say, 10 to 15 years. We're using an accumulation product. After year 15, the cash value hopefully will have grown enough that the trustee could start accessing cash value, either withdrawals or loans, and starts to repay the split dollar loan. And nice part about that is that's providing cash flow to the grantor. And so they have liquidity they might not otherwise have coming from the loan repayment. And even after the loan is paid off, the trustee with a grantor trust has the authority to make a loan to the grantor. And so we can continue to access cash value out of the policy and loan it to the grantor to supplement their cash flow. And again, when they die, they're going to have a large note payable to the trust, and that's going to reduce their taxable estate. So this is something we've been doing a lot of with private split dollar. And it's there because it works well, is about the easiest way to describe it.
Well said. So each premium payment is considered a separate loan. Given the urgency of setting up and pre-funding these trusts, I mean, does it make sense to just advance one big loan in the current year?
Certainly you can. You can make a long-term loan that would be locked in the interest rate until the life expectancy of the individual. which let's say that's age 86. At age 86, they're going to have to refinance the loan. Under the IRS rules, the loan then has to bear interest at a then appropriate AFR rate. And so right now, the blended AFR for 2021 is 0.13. The October short-term rate is 0.18. If you try to follow the IRS rule where each premium payment is considered a separate loan, even keeping track of annual premium with separate loan buckets for the next 15 years, because you're going to pay 15 years worth of premiums, trying to maintain 15 interest rate buckets. If you want to pay off part of the loan, do you take it from the highest interest rate bucket or the oldest or the newest? I mean, there's a lot of administrative issues, and the current low interest rate environment makes it sort of painless to go with the blended AFR. Now that may change, and we've actually played around a little bit, but I don't know that we have the IT resources in LifeComp right now. We've been considering creating a single long-term or mid-term bucket for them to use, that they could sort of refinance the blended AFR loan into a locked-in long-term loan. And it's still on my to-do list, but if we do it, it would only be like one bucket that you would lock in. And yes, it's something that sounds possible, but you got to have the IT resources to do it. Either that, or somebody has to be really good with a Excel spreadsheet.
Chip,
much better than I am.
Chip, give us the impact of using a grantor trust and coupling that with a split dollar arrangement.
Yeah, well, the grantor trust, and again, this first bullet, the trust grantor pays the income taxes on income generated in the trust. That is often a very sour pill for the grantor to accept. He says, wait a second, I put these assets in a trust, and now you're telling me I have to pay the income taxes. And the correct response is, and isn't that great? You're getting to make a tax-free gift to the trust. No gift tax. You get to pay their income taxes, and it's not counted as a gift. You should be happy rather than irritated. But sometimes that they just look at that and they just don't like it. Yet the key to it is that the entire investment yield, whatever's in there, and it may be after the death and payment of life insurance, that it stays in there. It may cease to be a grantor trust at that point if it was the grantor that died, but sometimes it'll be the other spouse may be the grantor and the insured. But it's that payment of income taxes that reduces the grantor's taxable estate as well. And so it takes a lot of persuasion with certain clients.
Well said. Here's an example, Chip, of how you can create this arbitrage and pay off the note and create enough cash flow to generate several $1 million of insurance.
Right.
Do you mind walking through this?
Sure. This is a very simple type variation on what estate planners have been using with sale of assets to a grantor trust. And if they're transferring a family business, then they take the cash flow and they pay down the loan over a number of years. What we do on the life insurance side is we say, okay, put $5 million, make a $5 million loan to the trust. And we're going to assume that that 5 million is going to earn 6% a year. And if you look across, you'll see that's 288,000 of earnings each year. And we're going to subtract from that $188,000 of premium. And it just happens to work out that we've got a 2% loan in this case. And so we got 2% of 5 million that's payable to the grantor. So we're able to pay the 2% interest to the grantor. That gives them some cash flow, gives them some cash to pay the income taxes on the assets in the trust. But more importantly, we're funding the life insurance. And I'm trying to remember what size death benefit we had in this case. Next page. All right, $4.8 million.
Yeah.
So, it seems at one level, it seems difficult to say, okay, you're going to loan 5 million and we're going to repay that to you. And you're going to end up with a $4.8 million death benefit outside your taxable estate. And it takes a while to sink in, but eventually they figure it out. And in this example, we were using the 9-year midterm AFR rate, which is lower than the long-term rate right now. And again, that rate is going to change every month, and it's only good for about 2 months. But here it's 2%, and that's above the long-term AFR rate right now, I think.
Yeah. So that's a pretty conservative, easy back of the napkin type math.
Right.
Chip, what happens if you don't earn 6% in your trust, and does this whole thing fall apart?
Yes and no. I mean, if you earn negative returns, yes, it could actually go to zero. But the strategy with this, and one of the reasons in today's environment, I will make it a 20 or 25-year note, is that, okay, after 9 years, I've paid all the premiums it takes to fund the life insurance. And yet I don't have 5 million in the trust right now, but I have income that's being produced. And so if I extend this arrangement for a couple more years, then that income should grow back to the 5 million, and then I can pay off the loan. And so the idea is that even if it was down to 4 million, you're no longer pulling premiums out. You're just paying the loan interest. And hopefully the assets will appreciate back and get you to do more than the 5 million so you can pay off the loan. But at the same time, I've seen variations on this where they get to year 10, they could pay off the loan, but they've locked in the interest rate for many more years. And so they just keep letting it run. And so all of the growth on the side fund is outside of their estate, and it's not a gift to the kids.
Right.
But we got started with this with the 9-year midterm AFR loans.
Well said. So, as we mentioned, and we bring this to a close, we Life Brokerage and Chip's team can certainly provide custom case design using the Life Comp illustration software. Insmark also does a nice job with the split dollar, with their split dollar module. What you get with Life Comp is not just the illustration system, but you get all the documentations and the administration, which is wonderful. At Life Brokerage, we always like to start with a fact finder. We want to make sure that split dollar does meet the client's goals and objectives, and they have the liquidity to do so. If they don't have the liquidity to do so, maybe we'll look at a different or alternative planning strategy. But it all starts with the facts of the case, and then we will engage our partners like Chip to put forth the best solution for your client. We answered just about every question along the way and weaved it in and out of the presentation. So Chip, we are question free at this point. I want to thank
Okay.
you. Yeah, I want to thank you for joining us and your wisdom around split dollar arrangements. We think that this is an extremely viable tool, particularly as we move into November and December of 2021 and prospective tax changes. So be sure to reach out to your life brokerage marketer, complete a fact finder, use us on a consultative basis, and hopefully we can put forth a solution to your client that can convince them to take action. So thank you for joining us, and our meeting today is adjourned.
Thank you for joining us. Yes.
Chip, thank you.
Okay, my pleasure.